Hello, everyone. I have Jack Schwager here with me again. So a round of applause. There we go. Welcome, Jack. Thank you for being here. And just for everybody else who's joining us on this, I wanted to explain what was my motivation for doing this podcast and specifically bringing Jack again. So one of the things that Jack does, he helps the retail traders like nobody else. First of all, he's very honest about what it takes to succeed in this difficult business. He always shares with everybody all the trade secrets that he has, not hiding anything. And this is the 100th podcast of Optimus Futures. So I thought it would be really great to bring you here again. This is the book of Unknown Market Wizards. And I really recommend this book. I will post a link to Amazon for everybody to purchase it and read it. What I would say is just read this book in its entirety. Here's what I've done. I've first listened to this book, and then I've read this book, and then I went back to the end of each chapter and highlighted the most important things. And I'll tell you, if you'll do that, you'll discover a world of secrets out there, if I can call it secrets, of what successful traders do. You might not get it the first time around from reading it, but if you listen to the book, read the book, and then go back to it, you will see that you will observe a lot more. Jack, I love the format of this book very much. I think I can tell how much effort you put into not only doing the interview, but then writing your own conclusions about each author, and then basically also adding their observation of themselves and your observation of them, which is phenomenal format. And I'm going to tell you something. I think really this is the best Market Wizards book that you've written so far. I've enjoyed the first two, but this one gives me more than anything hope for the retail trader. If they apply themselves, they can succeed. And I'm not downplaying the risk of trading as a licensed broker, but instead I'm encouraged that there are people out there that don't just go to forums and Reddit threads and just put all their money in one option and blow it up, but just people that are methodical. So again, highly recommend to get this book and go back to it as much as possible. Okay, Jack, we're going to start with a few questions here. I know you're a very busy individual, so anytime you just want to cut off this interview, you let me know because I have a lot to talk about. So the first question that I have is this. What did you find in common with all the successful traders? So as a group, I know each one of them is unique, but what did you find in common to all of them together?
Well, methodology-wise, they're obviously very different. Although in this book, there are a few traders who use a similar approach, which is coincidental because at one time in their careers, they happened to be at the same prop shop and knew each other. But generally speaking, it's safe to say that the methodologies do range dramatically across the board. But what just about, I guess, all of them have is, with maybe one exception where it's not the primary thing, but the most common denominator goes back to risk management. And you will see chapter after chapter how critical the risk side is to everything they do. And I think another thing is, in this book particularly, you find a lot of the traders are very self-aware, a lot of introspection, a lot of analysis of what they do right, what they do wrong, what their emotions are at the time they trade, concentration on getting very much into focus when they're trading, relaxation techniques to eliminate all the distraction and emotion. So psychological aspect really does, not for every trader, but I think this book more so than than some of the other books, where it's always important, but I think in this book maybe more so than in any other market wisdom book, that psychological element is in the forefront.
I see. And so they obviously have a certain way that they think, a certain way they behave. From what you gathered, were they successful at something before they approached trading? Were they already, and I'm not saying necessarily successful financially, but were there in other fields that made them this way? So if a person, what I'm getting at, if a person's first risky adventure is trading, how likely is he to succeed if he didn't bring a discipline with him from a different profession? And if he is, if trading is his first risky adventure, what would you tell such a person?
Well, in the majority, I'm just scanning some of the chapters. In the majority of cases,
Sure.
these people started out as traders, and that's kind of, and more so than is typical. Although they were not, some of them were immediately successful. Some failed, and then came back again. But a lot of them, most of them didn't have careers before the trading. Trading was their first career. And other exceptions, the systematic trader really fell into trading because he was a successful software developer. So, and was of a company that got acquired. He used that as his trading stake. But none of the traders had, other traders had, one trader, Brand, was in advertising, had a successful career in advertising. But most of them just really trading was the first thing they did. And I think Chris Camillo also had a career in kind of market research type of thing, where he was doing well, but I would, not an incredible success. Not one of these. He was earning a good living, but that's about it. So none of them was spectacularly successful in other careers before doing that, and the majority trading was their initial career. Classic example.
That's encouraging.
Yeah, like somebody like Jeff Newman, who has probably the most spectacular record. I mean, defying all reason and logic, graduated college, never looked for a job, and decided he wanted to be a trader. Now, I think most people will not succeed that way, but he succeeded spectacularly well. So I guess that's possible.
Okay, well, that's, like I said, it's very encouraging that people can actually start out at trading, make the mistakes that they do, fix those mistakes, develop a process, go forward with it. That's really good. So you talk to a lot of retail traders. They come to you, they obviously probably ask you, how can I be successful at it? What do I do? And everything else. So what do you find that this unique group of people, that they're exceptional at what they do and definitely don't represent, the typical retail trader, but what would you say in terms of approach that the retail trader does on a large scale that those guys don't do? How do they different in their day-to-day, in their approach, in their outlook, in their spontaneous reactions? How do they different in their nature?
They're different in that by and large they're, as a group, very, very disciplined. Very disciplined. And discipline means a couple of things. It means doing like a tremendous amount of work as part of the preparation for trading. So, like writing down notes on every trade they take and things like that. And literally, a couple of traders bringing to me binders of their notes on trading that they've accumulated and their experiences and all that. literally thousands of pages, and reviewing them. Or developing their system over years of hard work, if it's a partially systematic approach. The discipline also comes across in the risk management side, because like so many traders will, when they have high confidence on a trade, they will take a very large position. And the only way you can survive that is if you never make a mistake about delaying when you're wrong. So they have the discipline to just, if it doesn't go their way, they're out very quickly. So that's another dimension of discipline. So that's kind of one major aspect. I think the work they do as a group is probably more intense than typical retail traders do. They develop their own methodology. They're not asking other people what to do. They developed a particular approach that really works for them, and that's it. And they don't care whatever people say or do. They don't try to get other people's opinions. Like the most common type of question I will get sometimes from people by email is like, can you tell me what the best approach is, or can you tell me somebody I can train under? The typical retail trader is looking for someone to give them this magical approach, money machine on a silver tray. Instead of doing all the work themselves, instead of developing something themselves, they're looking for a handout, of here's how you do it, and that's just the wrong mentality. If you can be successful as a trader, you just have to develop your own approach. And even the traders where in my various market wisdom books, where they might have mentored with someone else, it's never that they mentored and that's the approach they use. They may have learned some stuff, but they didn't trade that way. They still traded their own way. They may have learned certain aspects from some other trader, or seen that it was possible to succeed, but they didn't get their methodology by copying another trader.
That's I can appreciate. We're myself. I'm also being approached, being asked the same question. I always try to convey to people that their nature will play a very big role in the application of the risk management. They're trying to duplicate somebody else's nature, risk management approach. It never works. I could never explain to somebody 100% how I think about the markets, both because I think a lot of people not be able to adjust it from a risk management perspective to think the way I am, but also conveying to somebody something that comes to you as second nature of your risk management. That's the part they don't understand. That's the part where they work with what God gave them as DNA, which is really to max out your losses and minimize your profits. That's the majority of what we're gifted with. And to go against it, yes, it takes a lot of hard work. It takes a lot of exercise, and like you said, a lot of note-taking and observation of your own behavior. So that leads me to the next question. Obviously, before on the other two market wizards, the people that were there were successful traders. These people are retail traders, as I call them. They sit there, their own monitors, their own screens. They apply their own method. You probably had some sort of inclination of what those people are like. Is there something that after all those years of being in the business, after you interviewed those people, surprised you about their personality and approach in terms of risk management, psychology, or anything else? Or was it pretty much in line with what you anticipated?
Yeah, well, the biggest surprise was when I did this book. I thought, not because they're like solo traders sitting in their home trading and not managing other people's money, although one of the traders does manage some other accounts, but by and large, image of a solo trader. They're not hedge fund managers with staffs and stuff like that. I hadn't interviewed in every Market Wizard book. I always had some solo traders, but this is the first time well, except for hedge fund Market Wizards, where it was as the name would suggest, it was basically hedge funds. But here, because it was, all the traders were solo, but that wasn't the reason I thought. I didn't think that was going to be a big difference, because I thought whatever the elements of success weren't so much dependent upon whether the person was trading sort of on their own, hidden from everybody, or whether they were managing money. The biggest surprise really was in how well these traders performed after a period of decades, maybe, where we've seen this tremendous quantification and computerization of trading. So you go back to the first couple of Market Wizards books, those traders, I was speaking to them in the late 80s, right? So their careers were 60s, 70s, 80s, but a lot of the trading career was, we had PCs in 88, but, I think PCs came on the horizon in any meaningful way only in the beginning of the 80s, probably. So most of their careers were not only this massive quantification in trading, but it was before even the PC. So since that time, you've had, an extraordinary increase in computer power, but also an extraordinary increase in, now, if you talk about just the ordinary trader, you and I or anybody else, on an ordinary PC, you have access to, a lot of power, much more power than you would have had on a mainframe or something back say in the 60s or 70s. And you have access to all sorts of data. The amount of data that's available. There was no intraday data. There was no, all this, in terms of fundamentals, access to all these different types of data. So you think with all of that, plus you have firms such as Renaissance and D. Shaw and firms like that, many firms, where you have literally, you might have 100 PhDs with math or physics or computer science degrees working to beat them, come up with methodologies to beat the market, plus super computing power. And you think of all of that, it would become much more difficult for the solo trader to really, maybe beat the benchmarks, but to do extraordinary would seem to be unlikely. So my biggest surprise was simply that the track record some of these traders had were actually not only as good, but I think in some cases maybe even better than the traders I had in the original Market Wizards books, where I thought those traders, they were phenomenal, but okay, so they were kind of early on. This was in the period where, like I say, people weren't very sophisticated. I remember like Ed Sakota, who was one of the first, very, very first people to be using systematic trend following. It was he had an exponential moving average system, which was no big deal. It was pretty straightforward, but it was so new that people they would call it the exponential, not exponential. They didn't even know what he was talking about. But because he was early on, and we had great trends, that gave him these massive returns. And the other traders too, like people like Marcus, that wasn't systematic, but he was great at exploiting these trends. And he would talk about how he would go in and catch something and get a move, and like, a week or two, after the move had gone, the dentists of the world would come into the trade. So, they had the advantage of being professional traders in a world that was filled with amateurs. And so I thought that was part of it. So I didn't expect to get phenomenal track records when I did this book, and I was surprised how good these people had done.
That is and you know what? It's encouraging And at the same time, I'm happy for them. I'm happy that they can take, ideas that are beyond theoretical and actually apply them and do better than all those PhDs. It's interesting.
And the lesson there is it's still possible. That's the big lesson, that despite all these changes that have gone on and the increase of professionals in the trading world, that it's still possible for the solo trader to still do extraordinarily well. Now, not everybody's going to do that. It's going to take a special type of talent and skill and emotional control on a lot of things, but it's possible. That's maybe the biggest lesson.
That's the one thing that really encouraged me after reading this book, of giving people resources of information of good decision making. I always change my advice to customers every few years, how to go about being better at this business. And in the last few years, I've been telling them, you just have to be a better decision maker. It first starts with good decision making. And I think the traders in your book are just good decision makers. They're good, like you said, they don't listen to anybody else, which is exactly the opposite of what majority of people do. The forums, trading forum exist. The whole existence of forums is people feeding off each other's weaknesses, giving each other's bad advice on an ongoing basis. Is unsuccessful traders giving each other advice how to overcome things. Well, these guys, in your book, are silent. Like you said, they don't go anywhere. They don't write anything. They don't communicate with anyone. So it's very hard to get that sort of information to say, look, somebody can publish something this big on the forum, right? And an amateur would read it and say, wow, he's so smart, I should follow it. Meantime, it's just hypothetical and theoretical nonsense that is not applicable in the real world. Reading it will make you a little bit smarter for a cocktail party. It does not mean you can apply it, in the real market. So I can appreciate everything that you're saying about their personality. One thing that I've noticed in the book, which really made me very curious, I've been telling people all the time, look, and maybe it's the right advice, and maybe this is something they've mastered, but I've noticed some traders would once in a while deviate from their risk and reward methodology on a day-to-day, and would sometimes take larger positions than they usually would. Now, I don't know if this is something that everybody should do, but the ones who have done it and are successful, how do you account for the fact that somebody can actually deviate from his risk and reward and still be successful? Because I
wouldn't describe it that way. They're not actually deviating from their risk reward. That is part of their methodology. Part of their methodology in the traders, you talk, these particular traders, not all the traders, but there's probably three that I think that fit that model. And in that case, their part of their methodology is to trade small or not at all, except when there's a very high confidence trader. In fact, one trader who he actually said that he's been called that, and I thought it was a perfect description of what he does. And the title of that chapter is The Unicorn Sniper. And it's the idea that he's waiting for the unicorn, that almost perfect trade. And there aren't a lot of unicorns in a year. And what he tries to do is really avoid the temptation of trading, or keeping his trading very small on other trades, and only really stepping on the accelerator when he sees that exceptional, what he considers a highly asymmetric return risk situation, where he can bet big, maybe, and in his case, he's probably had like 30 independent days where he's had returns of something like over 30% in a single day. And it's the fact that he tends to get a couple of those really high return days in each year, or, not necessarily 30, but he gets a number of really, let's say, double digit return days in each year. Now he gets these great track records. It's not because he's consistently making money. It's because he's very good at exploiting those situations. So that is his method. That's part of his methodology. This idea of betting larger on high confidence trades is a theme that's come up again and again. If you go back to the Druckenmiller chapter in New Market Wizards, which was the second Wizards book, you'll see that came in very prominently when he talked about what he learned working with Soros. And he said one of the things he learned about from Soros was you have to know when to be a pig. I'm paraphrasing here. And he tells a story which is illustrative. He talks about a time this is back in the days of the D-Mark, before the euro. And he talks about, he was very, very bullish on the D-Mark. And he goes into Soros and he tells him why and gives him all the reasoning. And Soros says, well, how big of a position do you have? And he says, $1 billion. And Soros says dismissively, $1 billion? You call that a position? Implying that if you're that bullish, why isn't the position larger? It comes in somebody like Thorpe, who one of the most incredible people I ever interviewed. And if I ever interviewed anybody smarter, I wouldn't know who it is. But Thorpe, who originally was into developing ways to beat the casinos, and became famous not because of his trading. I mean, people in the industry known for that. But before that, he became famous because he wrote this book, How to Beat the Dealer, where he basically mathematically figured out that while blackjack, like everything else the casinos play, is a negative edge game, it has to be, or else casinos wouldn't make money. But he mathematically worked it out that even if you bet correctly, you can bet correctly and you still have a negative edge. But what he understood was if you bet larger when the odds are more in your favor, namely when very few picture cards have come out, and small when a lot of picture cards have come out, that by changing the size of the bet, you could take a negative edge game and actually make it a positive edge. Which, if you use the analogy to trading, is that if you have different types of trades, and some trades are particularly reliable, even if if you average those trades, you had a slight loss or it might be slightly negative. But if you just bet biggest on those trades which had the highest confidence or the best return risk, that you could turn a negative edge into a positive edge. So I think this idea of betting larger on some trades is a theme that has come up again and again, and particularly prominently in this book.
Yeah, I still find it very fascinating, their skill set to identify such trades and be patient and not to do a lot of transactions, but wait for the right risk reward. You're right. Deviating from the risk management was the wrong word. What I meant to say is, it's maybe a change in what they do day to day in terms of risk management. If they risk X amount of dollars, then they'll trade on a larger trade 10X all of a sudden once in a blue moon. So they do that. I think it takes a very, very skillful person to recognize such an opportunity. I definitely don't encourage it, to everybody to start out that way, because this is where accounts get blown up, where people just fall in love with the position, or they develop some sort of a conviction, or have some sort of another FOMO factor, after Twitter and, other social media aspects that cover it. Jack, you're so right about the challenge that, these traders face, not only in terms of what you said, in terms of quantitative analysis that it's out there, the HFTs and everything else, but really being loyal to their value system of not listening to others and blocking themselves from all the noise out there. Even in spite of all my experience in the market, it's sometimes hard to shut down everything around you. To shut down the websites, the Twitter and the other forms of media that just blast information about the market, that even though, inside that this is just somebody was forced to an opinion or somebody had to write something, to actually really truly ignoring it psychologically, it's a real challenge. So these traders do face, bigger challenge than the other guys in terms of, all the exposure and the opinions and everything else. One thing I'm curious about.
Jason Shapiro not only doesn't ignore it, but he uses all that
Right.
Like CBC as an inverse indicator. So it can
Correct.
be.
But what he does.
The only case where somebody's paying attention, it's in a contrarian way.
And as I understand, he also has the ability to aggregate the data through his software to have meaningful input out of it, right? So it's not that he's looking at one Twitter and forming an opinion. He has the ability to use collective data, aggregated in some way that's presentable in some sort of a format that he can either be a contrarian or a non-contrarian. I remember that guy, right?
That's Chris Camillo, who basically uses social media as his whole input. He doesn't use fundamentals. He doesn't use technical. And in his case, he's looking for early signs of a trend before it shows up in earnings, before it shows up in anything. So, for example, a number of years back, where people were switching from sugared sodas to these, flavored carbonated drinks, like LaCroix as an example. And so he would spot things like that because he saw a lot of chatter, and he would do this. He would monitor it in terms of large relative to other things, and so he could spot these trends early. So he'd buy a stock like National Beverage Corporation before it was on anybody's radar. So in that case, it's not that he's listening to other people. There, he's using the social media input to identify trends very early.
I see. Yeah, I've seen that done. I've seen that done before. You're right. One thing that I'm curious about, and again, to your point of, that they're competing there with PhDs and algos and HFTs, and they've been doing this for quite some time. I think one of the challenges that retail face is moving from one trading environment to another, both in terms of belief and both in terms of ability. So they believe that there could be one method for all seasons, which the method could exist, but the risk reward maybe has to change. But also they have, even if they say, okay, I know I have to change, I don't know if they know when to change and how to change it. So from these traders that you interviewed, how do you think, or what is your perception of how did they move from one environment to another? And let me just be a little bit specific. I mean, are they profitable until they notice that they're not profitable and then they change it and they try to see what's going on, or they know in advance, if it happens? And I know there's no secret formula to it, but just your observation of how they think about changing environments.
They don't know in advance. And you will see in a number of chapters where specifically the conversation really is all about how they change. So, like you say, you can't have just like one approach and it stays static throughout time. And I think again and again you'll see this. For example, the best example is Marston Parker, who's the one purely systematic trader. He's the ex-software guy. and that's all he's never traded other than systematic. Now, for the initial years he was in the business, he had this combination of systems, and they made money steadily. And then he noticed that all of a sudden there was this one year where he had like 3 losing months or whatever. It just stopped working. It didn't work. Stopped working. And he his hypothesis was it stopped working because he's waiting to the end of the day to get data, and that's just too long for his type of approach. So he changed it. But here's the amazing thing. Okay, so since he's a software guy, when I was in his home in front of his computer, anything we talked about, he could pull up. Like he said, maybe, I don't know, hundreds of systems, but whatever combination of systems, and he could pull up, well, here's this, and here's what it did, while I was trading it, and here's where, he even up to the current day, he knows exactly what that approach. So I asked him to bring up, the approach that first got him on this road of successfully trading. And it looks like a little mountain chart. And he gets to the point where he starts losing. And then he stopped, using it. Now, the extraordinary thing is, from that point in time, the system has consistently lost money every single year. So, ironically, had he continued with the way he started, he would have been wiped out. That image of this, of something that works really well and then works just as badly, as good as it was in those initial years, that's how bad it was after that. So if he did, in that interview, there were several times where he made these changes. And if he had not made those changes, he would have been gone. There's one of the discretionary traders who would, like initially, the way he made money was there would be major events like central bank announcement, and he'd be ready to trade on that announcement. But as the algos got so sophisticated that they could pull out words and necessarily, phrases, words, whatever, and could instantaneously generate orders that no human could be faster, even if he knew exactly what to do. And he had to adapt to allow for that initial, swing, and then in some cases maybe even trade against it. So he had to adapt. He had to change his methodology to accommodate the changing realities and structure of the market. Peter Brandt, who's a classical chartist, a lot of the patterns he used no longer work, and he's the first to admit it. But he continued to be successful because if something stopped working, he understood it, and he just then had fewer patterns that he would look at, and it's only the ones that he still considers reliable that he uses. So again, adaptation. So to be successful, you have to be able to change.
Find it fascinating. I just find it so interesting how these people change, and that's because, like you said, they're very observant, very self-conscious. They don't fall in love with their method. And I'll tell you this. It makes such a difference when you develop your own method. I'll tell you, in the retail world, and I don't need to tell you how the retail world behaves, but, they buy indicators, they buy mentorships, they buy courses. And, one of the problems is that because they paid for it and because they haven't developed it themselves, they really stick to it. Like you will find people sometimes say, I'm invested in an indicator. Well, what happened if this indicator disappeared? You're no longer going to be a trader? And I think there's just an emotional attachment to things that they have purchased and bought, or people have told them that they perceive them to be successful and they might not have been. I think this part of change is knowing what to change, at what point to change it, where to change it. And because they have developed their own method, they are able to do that. That's just, this is what I attribute the ability to. They were there from day one. They thought about the method, about its risk management. Where do I apply it? What sizes do I trade? And they're able to change those variables because they know every room in their method. As far as if you've been to their houses, right? I mean, to those people's you traveled. Tell me a little bit. Interestingly, I want to know about their technical setup. I mean, more from how many screens did they use? How much time do they spend in front of the screen? What did you find, unique about their environment? And I'm going to ask you a question also with it. Do you find that their desk is clean? Do you find that they're very neat and meticulous people, or not really?
Well, I interviewed. Not everyone was in their home. In some cases, some of these traders they trade out of a office environment, as opposed to being home. So
I see.
Just let's say the broker they use will give them, an office space or whatever. And in some cases, I might have just done it in that. And I did some of these on the weekend, so it might have been in a conference room or something like that. Where traders, they range from, they might have I think someone like John Netto, who's, spent years and a lot of his own money sort of computerizing his discretionary approach in a way, and sort of will feed in his program where there, let's say, events that are going to occur, let's say a USA agriculture report, or what it could be anything. And he'll program in what he expects the market to do in each case. And then the computer will look for, certain things that may be keywords and will act based upon what the market is doing quicker than he could possibly do it. But in this case, he has 10 screens or something like that. He has a bunch of screens where it's his program, various aspects of it, and there's other screens where he's looking at. So in this case, he has a massive amount of separate screens going on. And so pretty intense. If you take something like Peter Brand, he basically will do all his work after the Friday close. And he puts all his trades in and decides everything he's going to do for the week. And he basically says, he hasn't actually analyzed it, but his gut feeling is that whatever minor amount of trades he does during a week, they probably end up net losing. And in this case, he doesn't have to watch the market at all because he's done it all over the weekend. He's put in his good till cancel orders and so you go from massive amount of screens to no screens. It kind of ranges. As far as their desks,
I try to
in most cases, I don't know. I don't remember any general impression. In a lot of cases, I didn't do. I mean, when I interviewed people in their homes, we didn't do it. May have been sitting out in the back, patio, and just talking. That was more typical than sitting inside. Certainly sitting at the desk.
I find, and obviously I'm, being catering to retail traders, and online trading, everything we do online. But I would tell you that the more successful traders we have, and I talk to, the less screens they have. I found, by the way, John Netto quite fascinating because he does exactly the opposite with emotions that most people are afraid, and so am I. You actually use it as a gauge, to actually tell him whether he trusts his intuition. Where most people's intuition misleads them, where they get excited or underexcited, his intuition actually he's able to gauge what he's feeling and navigate through that. But as I recall, he was also in the military, so maybe it's his military background that helps him, right, through that. So it's not a typical guy, just he's, like you said, being self-observant and self-conscious. Maybe he's using that sort of intuition to navigate him through the market. So I found him to be quite fascinating on that level.
Yeah, well,
okay, so
point because it's an unusual point. Well, first of all, as far as military, he was I was going to say ex-Marine, but I've been told nobody's an ex-Marine. Once a Marine, always a Marine. But for him, the Marines basically changed him, and he attributes his transition from being a continued like failure to being successful to his experience in the Marines. So that's part of that goes into his discipline and all that. But the emotional thing is interesting because in this book as well as in other books, I have made the point in drawing upon things that have come out of the interviews that human emotions are a negative input, and one of the things that's important to be successful if you're a discretionary trader is to try to avoid that, because our human emotions, as Bill Eckhart said, are so poorly attuned to successful trading that most people will do worse than random because of their emotions, because we make all the wrong decisions based on emotion. So that's my general advice. But Neto says, we're talking about this, and he says, well, why would you do that? Why would you want to get rid of emotions? And in his case, and I think he's a little bit of an exception, because I don't think most people could do this, but he's kind of trained himself to recognize his own his natural emotional response, and to use that as a signal that watch out. So if, like he says, if he, let's say, goes long gold, for example, and the market runs up, and he says, wow, this trade is so good, it's going to the moon, I should buy more. If he catches himself like with that, like this thinking there's no risk in the trade, this is just a layup. If he catches himself with that to him is a sign, that the sure sign that the market's going to correct. So he tries to gauge his own response as a proxy for the emotional response of other traders. And that if he gets kind of caught up in this emotional, this trade can't lose that thing, then that's a signal that it's going to go the other way. So he uses that in that way. But it's difficult, I think, for most people to be able to have a self-awareness to do that. And his point is, the good trades, he has to feel like it's a 7 or something like that. If he feels like it's a 10, then that's a danger sign, if he gets too cocky about it.
Yeah, I agree with you. It's very unique to do that, to actually use your intuition in the opposite way. Be observant of what you think, and act quite the opposite. The more knowledge I acquire through a reading, not only about trading, but decision making in general. I try, to read books that have to do with decision making to be a better decision maker. I would tell you that everybody tells you to stay away from emotions. Facts. Facts versus intuition. Statistics versus a vague understanding. To do that, I think most traders, to get to John's level of controlling your emotions that way, it's very challenging. Talking about controlling things and everything else, tell me a little bit about, if you can share a little bit about the journals that these traders use. Tell me what do they measure, and also the periods that they measure themselves. Do some measure themselves daily, weekly, monthly, and what do they measure and what do they watch out for?
Okay, so I'll get to that in 1 second. Let me just clarify. With intuition, by emotion, I'm not talking about intuition, because really good traders can trust their intuition, and that's different. I would define intuition as subconscious experience. So, these traders have been watching markets for decades or whatever, a decade or longer, and intensely, and there are a lot of experience and things they've seen. And it's not everything necessarily you recognize, oh, this is that. But sometimes you may get a trader may get a feeling this market is going up, and they may not be able to put their finger on why it is, but it triggers something that they've seen before, even if they can't identify it. And so intuition by itself for many traders is something that can be trusted on balance. I mean, not every trader, certainly not a particularly skilled trader or traders without a lot of experience, intuition may be wishful thinking, but I'm talking about traders where their intuition is triggering something that relates to past experiences, even if they can't identify what that is. Whereas emotion is like, I'm going to fear of missing out. Perfect example. I better buy this before it runs away, before it goes even higher. I've missed, the market is going straight up for 10 days. I better buy it before it goes up for another 10 days. That's emotion, or things of that nature. So that's what I mean, but that's different than intuition. Now, about what these traders who keep journals and stuff like that. So literally, they'll, in a number of cases, make just like every trade that they do, they will document. Why did they take it? What happened? How did it turn out? What was wrong? What mistakes did I make? What was right? Basically how the market reacted, what the idea was, how the market responded, how they reacted, everything about it. Okay, so that's in one trader's case. He not only does that, but he has a spreadsheet, an Excel spreadsheet with 30, 40 columns, and it's different aspects, different things of different types of emotions. And I'll give you just one example. Like one of the columns is a sugar trade. I said, "What's a sugar trade?" A sugar trade is when you take the trade because without a good reason. You're just taking it because you want to trade. So if he does that, he'll put an X in. So at the end of every week, he looks at the spreadsheet and he sees which of those columns have, a number of X's. And then he knows this is something he has to work on. So that's another example of the type of monitoring that they'll do. And a lot of it goes to the idea of learning from mistakes. And this is also, I think, a very important theme to becoming a better trader. Probably nobody made that point, or probably nobody I can think of for whom this concept was more important than Ray Dalio of Bridgewater. He built this whole firm on the concept of learning from mistakes. That's a core part of his philosophy. Is to become better, you have to learn from mistakes. And that's not only in trading. In this case, he points out that our educational system is flawed because it's all geared to getting the right multiple choice answer instead of training people, if they make mistakes, to learn from those mistakes and be able to grow from there. So, that philosophy of learning from mistakes is a very important concept because if you're able to do that, then maybe you won't avoid the same mistake 100% of the time, but if you're aware of it, you can reduce it significantly. And reducing the mistakes you make is critical to being a profitable trader.
Reflecting on your thoughts. So I agree with you. I agree with you on intuition versus emotion. I'm going to use the word intuition a lot more carefully in the future. When I actually, because the idea that I have in mind about a retail trader when he says I have an intuition that something will go up, you're right. It's just an emotional response. And yes, successful people who have been, like you said, observing the markets for many years. Sometimes there's a pattern that's built. Their brain recognizing it, but they can't verbally express what it is. And that's intuition, which is based on a lot of years of experience of, and anybody in any given business, whether they're trading or somebody in real estate can say, hey, listen, I don't think this property will work out. Maybe they say it because they've seen it so many times in the last 30 years of those things not working out, and they're able to verbalize, but they can't always explain why. So you're 100% right. To your point of mistakes, yes. look, the majority of people that I talk to, what I tell them, look, your trading is not done when the market finishes. Most of the time, they'll, and you know this, they will finish trading, and the process that they go through is thinking about what mistakes they have done and what they could have done better, instead of putting it in a journal and seeing patterns. And the patterns of mistakes that repeat themselves, that's where I say, wow, that is my weakness. I should really stop doing that. And this is where journals are so important, so they can observe and find their own edge in their trading to say, this is what I'm doing well, this is not what I'm doing well. And again, you become a better decision maker that way. So I 100% agree with you. You know, you made very good points. I would like at this point, now I'm done with my questions, but I would like to, I took a few quotes from the book that I loved, that I thought were just fantastic. And maybe they're simple, but they're just great. So let me get to the page where I put them. And okay, so here's one where Peter Brand said, he said, have a process, make a decision, write the order, place the order, live with it. And then he also said, if you're playing the emotional satisfaction, you're bound to lose, because what feels good is often the wrong thing to do. Your observation on that chapter, many, if not most, traders, particularly novice traders, fail to comprehend the critical distinction between bet trades and losing trades. The two definitely not the same. Let's discuss that for a minute, specifically with Peter Trent. Tell me your thoughts.
Yeah, so this is a mistake that many traders, particularly novice traders, make. And it seems logical to them, but it's totally wrong thinking. So most traders will think of, okay, winning trades, that's what I did right, and losing trades, that's what I did wrong. And that is actually really just wrong thinking, because the idea is, if you've got any process you got, I don't care what it is, no matter how good it is, you're going to lose a certain percent of the time. But if you've got a trading process that over time makes money with reasonable risk control, it's a good process, and then you follow it. You don't deviate. And then you have losing trades. Those losing trades are not mistakes. They're part of the process. You're not going to win 100% of the time. So if you do everything that's part of a winning process overall, but individually on that trade you lost, that's not a mistake. That's not a bad trade. It's just, you're just not going to win 100% of the time. And if you think it's a bad trade just because you lost, that'll mess you up. On the other hand, if you are, let's say, bored and you want to do a trade because your approach isn't giving you any signals, or you have nothing to do, and you want to sit there and root for something, and you buy a market or sell a market so you can root for it to go up or down during the day, and you make money, well, that's just a lucky trade, and that day it might have worked. It might have been a winning trade, but it's a bad trade, because if you do that over and over, it's just going to end up losing money. So the distinction between a good trade and a bad trade is not whether you made or lost money. It's whether assuming you have a winning process, the question is whether you followed that process or didn't. That's the distinction.
You know what? I loved it. It's 100% true. That's what I tell traders. Just because you followed a method that you developed and it wasn't successful on day one, because a lot of them will come and say, I did exactly what the method told me to do, and the market didn't make me money. And then they start disbelieving in the system or in their method or following anything. And then you're right. Then they resort to randomly doing something, making money, and they say this is so. Good point. Okay. Next point that I really liked in the book. And again, I mean, listen, every chapter had value. There's only so much that I could have, picked, but I picked my favorite ones that I think retail traders can learn from. Jason Shapiro, If you listen to anyone else's opinion, no matter how smart or skillful the trader might be, I guarantee it is going to end badly. So I particularly liked it. You can't adopt somebody else's method and risk and reward. You just can't copy their brains, right? You just can't. You have to develop your own, right?
Absolutely. Yeah.
Okay. All right. So to your point, there was Richard Barge. To be a good trader, you have to have a high degree of self-awareness. Mental capital is the most critical aspect of trading. You have to forgive yourself for making bad decisions. It's hard. You have to guard against the temptation of taking impulsive trades. And then your point, which was excellent in the chapter, if you feel uncomfortable about your trading, you should seek to identify the source of the discomfort and then modify your methodology to eliminate that. So you already mentioned about, also in this chapter, they mentioned about the outcome of a trade versus following a method. Do you want to elaborate a little bit about that point of, if you feel uncomfortable about your trading, you should seek to identify the source? How do you do that? How do you identify the source of discomfort?
Well, if you have to kind of do some self-introspection or think about what you're doing, but it's easier to explain in terms of a system. Let's say you're a systematic trader. I mean, the same thing would apply to discretionary, but I think the example is easier for the systematic trade. Say you have a system and it works, and then you see that, here's something that happened in the market that I didn't anticipate, and I really didn't think about this before I developed rules of the system. But really, if this happens, there needs to be an exception. So the advice there would be, well, okay, instead of trying to second guess your system, basically make that observation part of the system. So you add this, exception that if this and this happens, you don't take a trade, or if this and this happens, you do take a trade. So you adapt the system to take care of what you see as a flaw. Now, the same thing would apply to a discretionary trader. So you may have a certain approach, but then you see that, when this type of situation, I find that my hit rate is maybe not as good. These trade, when something, I didn't think about this particular aspect, but when this exists, or this circumstance exists, or in this type of situation, this approach, which is typically successful on balance, has a less probable chance of succeeding. And I really need to be aware of that. So the idea is to be aware of things within your methodology that you, through greater observation, realize need to be modified.
Thank you. Just a few more quotes, and we're near the end here. I really liked a guy by the name of Emrit Saul. He said, "It's what you don't do that counts. Patience is the keyword. Successful trading is the art of doing nothing. It's what you don't do between the real trade opportunities that will determine your success over the long run. You can do much damage to your mental capital between trades that when the big trade turns up, you are not ready for it." Jack, let's talk for a minute about mental capital and how important it is. The challenge that traders have, that taking losses after losses, it's sometimes mentally exhausting. And then, how many times do you replenish an account? Because a lot of the times, even I debate with myself. I'm like, how much is this trading thing is built on motivation versus skill? You need both of them at the same time, because if somebody is very determined to succeed, but he doesn't have the skills, maybe he has the money because, he's great in business or something else. But I'm always struggling this is where I can't tell traders, not legally and not morally. Legally, I obviously can't, tell anybody to put beyond risk capital. But the moral question is, how do you balance this, of motivation that you have to keep on going, and at the same time your mental capital when you see things are not working out until they work out? Tell me a little bit about how do you think to the best of your knowledge. I know there's no magic pill.
So you raise a few important points here. First, about the mental capacity, and so I'm going to deal with these separately. So that idea is that you get into a streak where every trader has this, where things are just not going right. You make a decision, it's wrong. You get out of a trade and the market reverses right after you get out. You hesitate in a trade and it works. And just everything you're doing is wrong. Okay, so when you hit a streak like that, if you just keep on going, you just dig the hole deeper and deeper, and one failure after each failure makes you kind of more off balance, than previously. So you're kind of digging the hole deeper. Not only that, if you get a number of failures in a row and you feel that you're just out of whack, when a really good trade comes along, you're going to be so scorched that you're going to miss it. You're not going to take it. Your attention is not there. Your confidence is not there. So on this whole point, when things are not going right, and I've brought this up in every book of traders, what do they do? And typically there's one or two things, and it comes up here in this book a number of times. Basically, the idea is, if things are not going right, just stop. Just stop digging the hole. Just stop trading. Stop trading could mean you leave for the day, or maybe you take a few days off, maybe even take a few weeks off. But the idea is to stop, to break that cycle, and then to gradually come back as you get more and more confident, as you feel compelled to start trading. So that's one concept. The other concept about replenishing the account, I'll give you some. This is not directly from traders, but this is just from my own philosophy. What I advise traders is that, particularly new traders or traders who haven't yet been successful, and I basically say, is have a starting stake. Don't make it too large, particularly if you don't have a lot of experience. And whatever that is, before you make your first trade, decide how much are you willing to lose before you say, okay, I don't have it right. The market is telling me this is not working. So let's say you start with 100K as an example. So maybe, and I'm saying that it's 100K of risk capital, that not that you can afford to lose 100K necessarily, but some of it is risk capital. And let's say that's the amount of your working trading capital. You might say, okay, if my account goes to 80K or lower, I am just going to close everything out and go back to the drawing board, and then come back in a few months if I feel I'm ready to start again. But simply doing that will keep people, what is so typical or happens so often, is traders will come in, they'll be overconfident, they don't really have the right methodology, they'll take a bunch of money, all their risk capital, and they'll keep on trading until they lose it all. And, then you're out of the game. Like I forget who said it in one of my books, if you lose your chips, you can't play anymore. It's like you have to be able to conserve enough money so you do have a second or third chance. And so many traders that I interviewed failed in the beginning that was, it's important because you want to be able to still come back. And so the advice I have is decide before you start trading what percentage of money really, that when you hit that point, no questions asked, you just liquidate everything at the market, close the account, leave the account open without trades, and just come back when your mind is ready and you're willing to try it again. But that is really, it's a very useful rule because it keeps you from losing a lot of money, at one time. It keeps you potentially in the game. And I myself am not trading for me is just a sideline. I don't trade all the time. Sometimes I'm trading every day. Sometimes I don't trade at all. Depends what else is going on in my life, how confident I feel, if I want to trade. But let's say what happened was happened to me. Typically, maybe I make money and then I start losing it back. I'll say, okay, things have stopped going well. I'll close the account for now, and I'll come back at another time. But whenever I do come back, I basically think to myself, I'm willing to lose X dollars, and if I lose that amount, I'm going to stop. And that sort of prevents that. It sort of gives you an edge because your upside is open-ended and your downside is very limited. So it's like the poker player who you put in the money for the kitty, and if you get a lousy hand, you'll just, okay, you lost that small amount. You're not going to keep staying in the hand and hope your cards come out better. So you control your downside, and but you have the possibility of a much larger upside. So I would not encourage people to keep replenishing accounts, or on the opposite, I would tell them to limit the amount they're willing to lose and then stop and then come back at another point.
I agree with you 100%. The one thing I would add to that is I tell every trader to start trading at the level of comfort that he can handle psychologically the fluctuations in his account. The majority of people today, obviously with trading being gamified, what it has done is young traders are asking for the most amount of leverage they can use for day trading. Not only, to say that leverage is a double-edged sword, for 90% of the people, it's just one direction. They don't know how to trade it in terms of risk reward like a professional trader. So what they do is they gear up in the initial trading career to the point that they think this is how it's done. And one thing to alleviate, this replenishing and go through this somehow of a mental suffering process because they want to succeed and they can't. It's exhausting at some point. I always tell them, we'll start at the level where the fluctuations do not only affect your account in a bad way from a risk reward, but mentally you can handle and withstand it. And that helps them. And I think the people that I've told it to, just to reduce gear a little bit, reduce the leverage, specifically, in our arena of futures trading, I think it helps a lot. So next sentence, which I love, doesn't require, a lot of analysis. It's from Daljit Dawal. He says, always make sure your stop is set at a point that disapproves your market hypothesis. So really, I think that's been discussed before. This is where you set your stops, where the market tells you that the hypothesis is wrong, not necessarily your personal comfort, because your personal comfort has nothing to do with the market, right?
Yeah, the market doesn't care.
Market doesn't care. Last two quotes, and they are from Chris Camillo, which they're basic, but they're so crucial. Don't try to change who you are to match some perception you might have about what professional traders do on Wall Street. And the second one was, don't even listen to anyone. Don't ever listen to anyone when you are in a position. And to that point, I would say, yes, a lot of traders behave based on perception how some other traders on Wall Street do it. And I found that on Wall Street, what I try to tell people, big banks, for example, yes, they have proprietary desks, but most of the time they're in the business of selling products, whether it's in the form of derivative or insurance, or this is where the revenue, is coming from, but a lot of people don't understand the structure. So a lot of the people do, again, revert to high leverage. They think that they know how Wall Street behaves, and based on that perception, kind of a shadow, they try to figure out how the real figure is acting. So I think that would lead to many mistakes. Jack, I'm out of questions, and I wanted to thank you very much for your time. I truly think that, you're one of the only people that really in this industry that shares information, again, in a very transparent way. I wish that some of those traders in the book, and I know they want to stay in their isolated world, but I just wish, that they had a way to convey more of what they do and share with the world, from a practical experience. I know that Peter Brand does it.
He does.
He's actually one of the only guys out there that actually has a track record that does teach people. Majority of people who are successful in trading don't teach. And quite the opposite, majority of people who teach, that's where their income is at from teaching. So I get it. So I thank you at least for this advice. So again, to everybody out there, Unknown Market Wizards, go and get it. Worth a read 5 times at least, and listening to it, obviously, on those apps on the phone. Jack, thank you again for your time. I really appreciate it. And until your new Market Wizards book, until next time. Thank you again.
Thank you very much. Sure.
Thank you.